HSBC India Investment Summit, Alternative Investments and Global Markets, in association with CNBC TV 18.
Hello and welcome to the HSBC India Investment Summit, Alternative Investments and Global Markets, presented in association with CNBCTV18.com. Today we are thrilled to have with us Mr. Willem Sels, Global CIO at HSBC Private Banking and Wealth, and he is joining us to discuss the rising importance of alternative investments in a world which is getting increasingly complex, where volatility has become the new normal. At least that's what 2025 has been all about. So let's straight away dive in. Willem, thank you so much for taking out the time and for being here with us in the studio.
A real pleasure to be here.
You know, you're here with us at a very, very interesting time. Like I said, it's possibly never been more confusing and consuming in the last couple of years, because you've got these diverse global cues, interest rate actions, and of course this new dispensation in the US, which is sort of brought around the narrative on American exceptionalism. So let's start there. I mean, how do you look at the extremely complex environment we're in right now?
It is a complex world, and indeed we are going to have a volatile year, but with ups and downs, two-way volatility, not just one directional. And it's important, I think, to also start by examining, what is actually the current situation. The current situation of the global economy, and particularly the US economy, which is all important in global markets, is very strong. It is a resilient economy. There's a slight slowdown, but obviously Trump will try to make sure that he also reaccelerates the economy. And at the same time, we actually have made a lot of progress on inflation. So we do think that we're going to have another 2 or 3 interest rate cuts from the US. That's a very interesting and positive mix for risk assets. So therefore, people need to be invested. But we are going to have headline risk. And that one we need to try to exploit, not only see it as a negative, but try to exploit. And therefore, we are really focusing on alternative assets, on hedge funds, and also within the long only on active management strategies, where you lengthen and shorten duration in your bond portfolio, or you take advantage of movements in the equity markets to pick up your favorite stocks. So
alternatives could be our best friends perhaps this year, looking at the way things are playing out. Just to complete the overall backdrop against which you're advising clients on the way the portfolio should be constructed, you mentioned that you're still expecting 2 to 3 rate cuts in the US, and that's interesting, right? Because in between, somewhere around December of last year, the US bond market was getting very, very sort of edgy, with bond yields shooting higher, and there was this whole fear around higher inflation in the US, and perhaps the Fed having to sort of take a bit of a pause. But do you think those concerns are out of the way for now, so 2 or 3 rate cuts?
So I think there's 2 elements in terms of the bond market move. One is the inflation environment, and the other one is the borrowing requirements of the US government, and are they going to be able to place all of those bonds. From an interest rate perspective, so the Fed policy, I do think that when you look at under the hood in what is happening in inflation, there is progress, and in particular something that was very sticky up to now, that was rental inflation, and finally you're starting to see that come down, and that lag is there because, as you know, the mortgages in the US are extremely long, so the lag has been much longer than people thought. Ultimately, now that rental inflation coming down, that's why we think we're going to have those interest rate cuts. From the other point that has driven up bond yields is indeed the deficit, and indeed people expect under the new administration that deficit to increase. But I do think that you now actually have quite a significant buffer, whether you talk real yields or whether you talk term premium in sort of more the lingo of the financial markets. There is that buffer for that growing deficit. So we are comfortable with 7-year bonds, for example.
Oh, that's very interesting. So more rate cuts ahead, and you're saying you like 7-year bonds. So in general, if we work with that assumption that the Fed will continue easing, is it going to be more bond positive or equity positive? So again, coming back to the portfolio question, and as people think about their asset class choices, what are you advising? So
we're not too far from what the market already incorporates in terms of rate cuts. We're maybe expecting one more than the market expects. So therefore, if it were completely in line, then you wouldn't expect price gains at all, right? So I don't think in the bond market you're going to make huge capital gains, but you are going to clip a decent coupon. And also what we advise clients is to try to take advantage of that volatility, that headline volatility that you're going to see by being in those active management strategies or being in the hedge funds that are going to take advantage of this as well. We prefer equities, and in particular US equities. I know that that they have already run quite far. But it is the economy that is the most resilient, that is the most innovative, and therefore we do think that companies can actually further push their margins up even further. People tend to, when I talk to clients over the last 3-4 weeks, we've done a big roadshow. There is obviously a concern around U.S. valuations. But you can explain almost all of the difference versus Europe versus the UK by 2 factors. One is the sector composition. They have much more technology, and obviously that trades at much higher valuations. And the second one is the ROE, the return on equities. US companies are just much more profitable. If you take those 2 into account, actually US equities are not that expensive.
This is really interesting, and we're having this conversation just hours after the world was shaken by a phenomenon called DeepSeek, this new Chinese perhaps technological boom that could upset the whole US tech apple cart. But you don't seem too perturbed about how US technology and US tech equities are placed right now.
We see how that evolves, but basically when we look at AI, we advise clients to look at the entire ecosystem. And so it's not just chips, it's also the entire infrastructure around that, the data centers, and also even more importantly, the users of it. So if you were to have models that are going to become much cheaper to operate, to develop and to use, this is going to be beneficial for the users. Whether it's obviously LLM or other AI that goes into the entire service sector, that goes into automation, that goes into new drug development, all of the tests that need to be analyzed and so on. So those users are going to be actually very happy with this if indeed that model proves much more efficient.
Interesting. So absolutely you have to stay with the AI chain and see who benefits and how this perhaps evolves as we go along. Okay, so to complete the piece on markets, you spoke about US equities, something that you still like. Let's talk about how you're weaving in other large markets, whether it's developed markets or even emerging markets in the portfolio at this point in time. 23, 24, for instance, were great for Japanese equities. And now the central bank that is talking about rate hikes rather than rate cuts. Then there is the whole China question. How are you looking at a couple of these big names? So
the US is our big overweight. Europe is an underweight because in this very complex world where there is huge global competition, Europe doesn't have the industrial policy. And obviously they are going to be subject to US tariffs as well. I must say that the market is very pessimistic already. So that is the potential upside. If there is a good news headline, it may move, but nevertheless, an underweight. For us, Japan is an overweight. You do say indeed correctly that we are having a number of rate hikes there, and we expect one further one this year in Japan. But companies actually in Japan are super happy that they are out of the deflationary spiral,
finally.
Which China is now struggling with. So we very much prefer Japan over China. We do think that China will obviously give even more policy stimulus to counter that headwind from the tariffs. But I don't think investors give China the benefit of the doubt at this stage. They will want to see a very big package. They want that big bang approach. We're overweight on India. And we're overweight on Singapore, both as diversifiers. India very much as a domestic market, and we remain positive even in spite of the somewhat weaker shorter-term data that we've seen from a cyclical perspective.
What role do alternatives right now have in a well-balanced global portfolio, you think?
So alternatives from a longer-term perspective, it's sort of a typical portfolio. We tend to have, a little bit less than 30% fixed income, a little bit less than 40% equities, and then the rest in alternatives. So another almost 30% as well in alternatives. That is hedge funds, that is private markets, and that is infrastructure as well. And a little bit of gold. Let's not forget about that. But the alternatives are very much in favor from our clients as well, even from a shorter term perspective, both because they see that equity markets have run up, and the bond markets, you don't see too many rate cuts anymore. So they're basically looking at alternatives literally as an alternative, but also to broaden that the perspective.
Okay.
Clearly, more and more companies are staying private for longer. They have the growth spurt whilst they're in private hands before they're doing the IPO. And therefore, huge opportunities set there. And infrastructure, again, is not just about building roads and bridges. It's very much about a transformation to a data-led economy, to electrification, and that entire build-out around that.
So private markets are looking good. And within that, hot sectors for the next couple of months, maybe
So
year
the
or
thing
longer?
the thing is, sometimes in the private equity market, you find companies that are not available in the public market. Of the companies that generate more than 100 million in revenues in the US, 85% of those companies are in private hands. So you see sectors, for example, like software, a lot in the tech sector, but also in the applications, as I said before. In the automation, even cooling, for example, of the data centers, you can go into very specific areas. There are these opportunities.
Interesting. So to complete the point on alternatives, you also said that you're looking at the infrastructure segment quite closely. So would that be kind of infrastructure which is in sync with the technology chain, like you mentioned, data centers? Is there anything else? How do you define that segment?
So to me, the infrastructure is more. So it's in part because of the re-onshoring that countries want to do, especially towards North America. That obviously leads to indeed some roads, bridges, ports. Also, it sometimes goes into real estate because it's the logistics part of it. But then a very important part, I think, is the electricity. Because it needs to, you obviously need to build that out. There is also a geopolitical aspect to this because countries want to be energy independent. So there is the demand that is growing, there is the energy independence, and then obviously there is the clean energy bit that comes in there. It is part of the solution. I think we will need all possible sources of electricity, and clean energy is part of that.
Okay, all right, very interesting trends there. We do have to take a very quick break, but we are going to come back to this conversation. How do you look at risk-adjusted returns in this highly complicated world, at least in 25 or perhaps 26? The conversation will continue on the other side.
HSBC India Investment Summit, Alternative Investments and Global Markets, in association with CNBC TV 18. HSBC India Investment Summit, Alternative Investments and Global Markets, in association with CNBC TV 18.
Welcome back to the HSBC India Investment Summit. We're continuing our conversation with Mr. Willem Sels, Global CIO at HSBC Private Banking and Wealth. And we've been discussing a whole host of wealth ideas in a highly complex world and the role that alternatives can play in your portfolios. So let's talk about, Willem, some of the future trends now. We've discussed a lot of what you're liking, the markets that you're excited about. But at the end of the day, for an investor, it's all about steady risk-adjusted returns. I do want to sleep also peacefully at the end of the day, right? So how are you balancing all of this using regular investments, using alternatives, given the volatility that we're perhaps expecting in markets this year?
Well, so the first thing is to think longer term. When people are nervous, sometimes they get out of the market and then they don't re-enter or they don't re-enter sufficiently. And so, as you know, timing the market is very difficult to do, but the time in the market is what really ultimately leads to your longer term returns because of that compounding and so on. I do think the risk that people also have from a longer term perspective is obviously that they need to at least match inflation. And therefore it's important to have a number of assets that give you an imperfect but some kind of inflation hedge. And that is obviously equities, because equity revenues, companies' revenues are nominal. They go up when there is some inflation, not too high inflation, but some inflation. I talked about infrastructure, which has a link to inflation embedded quite often in the revenues of infrastructure companies. And then gold tends to, at least from a longer term perspective, be linked to inflation. Not so much currently, but so those can help. I think it's about the global diversification as well. Especially country-specific volatility can be painful if you live in that country. So to have the globally diversified portfolio, we tend to advise particularly to clients who have lots of assets or a business locally in a particular country to try to have their portfolio almost entirely outside of that country.
For diversification.
For diversification, and diversification to me is not just dampening volatility, it's also broadening the opportunity set. And that tends to be a much more interesting conversation when you have that with clients.
Yeah.
Diversification tends to be, they see it as boring.
Absolutely. Opportunity is a much better, more exciting word,
Exactly,
right?
exactly.
So where are the opportunities? Where do you see them now?
So I do think that when you build a portfolio with public and private assets and alternatives, you can obviously make those allocations 40, 30, 30. Or you can say, actually, I am thinking of this in a completely different way. I'm thinking about how can I take growth risk? Because I'm bullish on growth, I'm bullish on earnings. And you can do that in the public markets. You can do that through hedge funds. You can do it through private equity. Another, if you want to take interest rate risk, you can do it in the bond market. But again, you can do it in the hedge fund space. You can do it in private credit.
Yes.
If you are looking at commodities, you can do it directly. You can do it in CTAs. So that's a different way of looking at it. And more people, tend to do that.
Do you, at this point, I mean, given this backdrop, do you see better risk-adjusted returns coming in through the alternative route?
Yes, I do think so. So basically what we would call this is Sharpe ratio. Risk-return relationship over the longer term. And what you currently see is that because of the rally in the equity markets, the very long-term outlook risk-return for the equity market and for credit, so for corporate bonds, is not necessarily all that attractive. So where the value lies in what we call the barbell of high-rated bonds as well as alternatives. And in part, obviously, because those alternatives still have that illiquidity premium and that pricing differential. And the pricing differential comes from the fact that there have been so few IPOs, so little M&A, that the private markets, stayed at relatively low valuations while the public markets drifted up. I think that is going to close, and that therefore, brings adds to the return from a longer term perspective.
Got it. I want your take on three specific areas which have been in the news. They've been really hot over the past many months, I mean, over a year or two. One being obviously technology, the second being energy transition, and the third being crypto. So let's take them one by one and see what you've been advising clients. On technology, you briefly mentioned that, of course, you do like the US tech story even now. But how are you advising people to play it, given that valuations are really high in the listed equity space and perhaps there's very little room for error?
Yeah, so I do think, from a shorter term perspective, pricing is not a good indicator for the returns over the next 12 months. It is a very good indicator for the return over the next 10 years. But so, if we are talking here about the opportunities now, I wouldn't start with, oh, something is expensive, therefore I don't want to be there.
Sure.
I do think that you are going to see significant growth still, but the growth gap in earnings between the Magnificent Seven and the other sector is shrinking. And that's us saying that, but also the consensus actually saying that. So you're seeing an acceleration in sectors like industrials, financials, and so on. So keep your technology, but start to add exposure to other sectors as well.
And perhaps look for newer technology ideas in the private space, like you mentioned?
Yes, lots of opportunities there, and typically at lower valuations.
Okay, so that could be something to think about. Now, on energy transition, I think this would have stumped a lot of people, or maybe the market saw it coming, maybe investors knew it coming, because the US president has been talking about doing it, and he's done it. He's pulled away from the Paris Accord, and he's talking about drill, baby, drill. So what is the House view on the whole energy transition piece? Now, whether you're playing it through, private markets, public markets, debt or equity, and how are you navigating this now?
So drill, baby, drill will be the oil sector and the natural gas sector.
Yes.
And we think there, we're not that optimistic actually about the prices. In part, of course, because when there is more supply, then pushes the oil price down rather than up. So for us, the energy sector, the oil sector, and from an equity perspective, is a neutral allocation. We think that there are opportunities more in the build out of the infrastructure, the electric grid, for example.
Okay.
It's very important, especially if you do a transition where clean energy at least continues to play a role regardless of what the
So you're not
US
getting rid of all your EV or clean energy bets so far in the portfolio?
No, because I do think that there is such a demand in energy, in electricity, that we need all of the solutions. So we have added more nuclear because we do think that is probably in terms of the mix going to pick up in terms of one of the solutions. But clean energy has become more competitive because of the economies of scale, right? The demand has been goes up and obviously the technology there improves as well, so it becomes cheaper. What we really like is as well is the companies that build out the grid, because you need to connect all of this. Because we've had, especially in Europe, we've had areas, points in time where you had very low prices in one country and extremely high ones in the other country because there was a supply deficit, the sun didn't shine in one area and there was too much electricity in the other. When you connect it, you solve that problem. So the people who built that out, they are going to be very busy.
Okay. So there are still opportunities existing in the clean energy or maybe the nuclear energy space as well. Got it. And crypto. Now, again, a lot of it is going back to what the US president has been saying, right? What's the call? Are you taking positions, not taking blockchain? What does that mean for investors?
So for us, it's not an asset class. Okay. To be an asset class, you need a number of things, but you also you need for it to have an economic benefit. So either typically you have an earnings generation or you have an income stream. More importantly, for us, to be able to put it into portfolios, we would need to have some idea as to where it is going. And for that, what we do is we do the correlation analysis with different factors. And the problem is that it is a real chameleon. It changes shape. Sometimes it is a risk-on asset. Sometimes it's correlated with gold. Sometimes it's with technology stocks. It doesn't seem very correlated to inflation or to interest rates or to the dollar. But so if you cannot forecast it, you can't really do that long-term, modeling and benefit analysis of why would I have it in a portfolio. What we're really saying to clients, because I do get more inquiries, is that if you have it in a portfolio, make sure it is a small piece, because obviously it is very volatile and it could dwarf the entire volatility of or dominate the entire volatility.
Absolutely. I mean, that sounds like very, very logical advice. So finally, Willem, wealth tip for anyone who's watching this conversation, your wealth tip for 2025.
I do think that people need to continue to build out their alternatives in the portfolio, and that means hedge funds as well as private markets, because it helps you, certainly from a hedge fund perspective, to manage that volatility and take advantage of it, and from an alternative perspective to look through that volatility and to look at different opportunities that you don't have in the public market.
All right. Well, thank you very much. This was a very, very interesting and very insightful conversation as well, very helpful one. Thank you for joining us here in the studios today.
A real pleasure.
All right, with that, this is a wrap. That was Mr. Willem Sels with valuable insights into the world of alternative investments and global markets. With this, we come to the end of this very interesting and engaging session at the HSBC India Investment Summit, presented in association with CNBC-TV18.com. We appreciate your time. Thank you for watching.
HSBC India Investment Summit, Alternative Investments and Global Markets, in association with CNBC-TV18.